When banks buy gold quietly, it's not a bet on price. It's a response to pressure, and that pressure is already here. Just a quick reminder, this content is for educational purposes only. It is not financial advice. I'm JP, a former banking insider, here to break down how institutions actually think about money, risk, and cycles. This channel exists because most people are never shown how these critical decisions are made till long after the opportunity has passed. So, let's talk about what most people get wrong. When headlines announce that banks are buying gold, the average person hears one thing. They must think gold prices are going higher, but that's not really how banks think. Banks don't speculate. They don't wake up in the morning looking for a big upside win. They wake up managing their exposure to risk. For a bank, gold is not a growth asset. It's a risk offset. Think of it this way. Gold reduces the dependence on promises. What kind of promises? It's a promise that a currency will hold its value, the promise that a counterparty will fulfill their obligation, and the promise that credit will remain available. Okay, gold doesn't rely on someone else's word. It just is. This brings us to a crucial point that most channels about precious metals never explain: how banks are actually incentivized. You have to understand that incentives drive behavior. A banker isn't rewarded for being right about the price of gold. They're rewarded for surviving periods of stress. No one gets a promotion for calling the top or the bottom of the market. They get promoted for skillfully managing risk through deep uncertainty. This comes down to three key areas: regulatory pressure, balance sheet optics, and liquidity preservation. Regulators want to see stability. Gold shows up on a bank's balance sheet very differently than most other assets because it doesn't rely on someone else paying you back. It's an asset that stands on its own, which makes it incredibly valuable for demonstrating financial strength and maintaining liquidity when cash is tight. For those in the know, it's a premier Tier 1 asset. So, why is this happening now? This is where you gain an edge. Banks don't react to panic. They react to early signals, long before those signals become front-page news. What are they seeing? Increasing policy confusion from governments and central banks. Okay? They're seeing instability in interest rates, which affects everything. They're seeing a slow but steady erosion of trust in major currencies. And they're seeing liquidity, the lifeblood of the financial system, begin to tighten. Remember, preparation always comes before the headlines. When enough of these pressures start to overlap, banks don't sit around waiting for the situation to become clear. They position themselves before clarity arrives. This isn't about fear-mongering. It's about creating urgency by showing you how the smart money prepares. Here's why this matters so much. Institutions always move first. Public awareness comes much, much later. There's a predictable sequence to these cycles. First, banks and central institutions begin to accumulate gold, which helps stabilize its value. Then, you often see silver begin to accelerate as more retail and institutional money flows in. Following that, mining equities start to get repriced higher as the market recognizes their potential profitability. By the time this entire process becomes obvious on social media and in the news, the easy part of the move is already gone. This channel exists so you don't have to guess what's happening after the market has already priced it in. If you want to understand these cycles while they're still forming, not after they've finished, then you are definitely in the right place. Thanks for watching.